Well, let's get going. I hope everyone is doing well and excited to be here today to talk about some good things that are going on in the economy and in MTI's markets, and of course, amongst you all as well. And the most important thing that I'd like you to walk away with from today is that when we look at our system of leading indicators, they're rising. That rise is pretty mild, and that's indicating for us that we are going to see growth over the next, we think, few years, but at least over the next year based on the leading indicators, and that growth is likely to be mild. So when you think about planning for next year and beyond, we want you to have that mild growth mindset and really be basing, as always, your planning based upon what the leading indicators are doing. And we're seeing that mild ascent. So let's jump straight to your data, the MTI data here. And you can see on a growth rate basis, we've been in this slowing growth period for some time. That is looking at the annual growth rate. That blue line on the right-hand panel of your screen has been coming down for some time, but it's just beginning to creep up now. And we see this as a transition into accelerating growth phase. So right now, sales are up 1.7% on a year-over-year basis. We think by the end of 2024, that growth rate is going to be 2.2%. So 2.2% growth in 2024 relative to 2023. And 2025, we're looking at 4% growth relative to 2024. So upturn in growth rates heading into next year. Again, that upturn is going to be mild. If you look at the peak for that growth rate forecast that we have, those are those little golden little hash signs off to the right over here. You can see that the peak growth rate over here is not going to be as high, very likely, certainly as the COVID cycle. We're not going to be seeing the kind of stimulus that we saw very likely in those years, either from a fiscal perspective or from a monetary perspective, but we are going to see some better growth here in 2025 than we have in 2024. So it's something to get excited for, and we all want you planning appropriately. And so we're going to be walking through some of those things that we want you planning for. I did get one question already. Split, let's see. Perspective on the split of drivers of growth between volumes versus price. Yes, absolutely. Some of this growth is going to be due to price. And I think that's a really good point. We'll be getting into some of the data on that later. But essentially, a good chunk of that growth will be pricing related. And so one of the things that we want you thinking of is when people see our forecasts for the next couple of years, people have been in this sort of weakening period here for a while, and I think are really excited about growth when they hear about what the leading indicators are doing. We just want you to level set those expectations because we're talking mild growth and some of that growth due to price alone. So this isn't like a go out and double your workforce kind of rise that we're talking about coming from a volume perspective. It's to be maybe slightly busier over the next couple of years. So let's talk actually, thank you for that question. Let's talk actually about exactly that pricing. And so what the first thing I wanted to start out with is we all know that inflation has been generally easing for some time here, but we're already starting to see signs that the next period of inflationary pressures are going to be building again. How do we know that? Well, one of the trends we look at here is Treasury issuances. So this is to support government spending, and you can see that they're very elevated here at this time. And so as we look off into the future, that elevated government spending is going to help breed some inflation. Another factor that we know is very likely to breed some inflation is the fact that the money supply, which had been contracting quite a bit here, that's the green line, is now basically even on a year-over-year basis, the most recent month compared to that same month 1 year earlier. That's what the green line is looking at. And so we've seen this monetary tightening that's represented by the green line going down, and that's has led already to a bunch of the easing inflationary pressures that we've already seen. That's the navy line. And it's going to lead to a bit more easing. Those are those dots for the CPI forecast. So we're talking about inflation easing into about the middle of next year, but then you can see it starts to pick back up. And that's a function of, again, those treasury issuances going out there. It's also a function of the money supply increasing. It's also a function of the fact that the economy is on pretty solid footing and the labor market in particular is tight. We're going to be getting to that a little bit later. It's eased some, but when I think of it from an overall perspective, and I think of the drivers of the labor market generally speaking, one of which is demographics, we don't have a lot of workers. And so those workers are commanding price increases, wage increases. That is fueling spending. That's leading to price increases. And that'll be a continued driver for some of these inflationary pressures that we are likely to see pick up late in 2025, but especially 2026. And we think inflation is going to be with us as a problem, as a painful problem for businesses through about the end of the decade. So as you're looking off and planning for the future, we want you to have that mindset of how can you be more efficient? How can you deal with those price increases? Another factor behind why we expect inflation to be going up is, let's take a look at gold prices. They're about a 20-month leading indicator, typically to consumer prices, again in blue. And right now, gold prices are up 36.3% most recent 3 months compared to those same 3 months 1 year prior. And the ascent in those gold prices, typically when we see gold prices really heat up, you can see they really were heating up during the COVID period. That led to the increase in CPI there. You can see they were heating up quite a bit post Great Recession there, 2011, 2012. We saw a little bit of higher inflation there. So typically when we see a really big move like we're seeing in gold prices right now, that is typically indicative of some inflationary pressures coming down the line. So in terms of what to plan for from a inflation perspective, we like to look at the producer price index here for a manufacturing type industry, industrial type market such as yourselves. And when you look on a year-over-year basis, we can see the producer price index is pretty much flat. That's the left-hand panel of the screen, those rates of change. On the right-hand panel of the screen, though, you can see that the price level is very, very elevated versus what it was pre-COVID. So when we talk about inflation going up, again, inflation is a growth rate of prices. That's those left bubbles beginning to move higher in 2025 and 2026. That's stacked upon this already higher price level. So that is going to be painful. If you look at those growth rates, they don't necessarily look that painful. 2.6% for 2025, 3.4% for 2026 for producer prices. But you're talking about those increases on top of an already high level. So that's going to be painful for folks who don't know how to be more efficient, who can't become more efficient. And so one of the things we really want you to think about is how can you get more efficient with what you already have and be more profitable in that way. Of course, coming along with inflation is going to be some interest rate challenges. So right now, what we're looking at as the 10-year government bond right now is about 4.2%. That's quite a bit elevated to what we saw in the decade prior to COVID. And for a long time, I was born in 1983, not to overshare, but most of my life, I've seen interest rates come down from those early 80s peaks all the way down to that COVID low, a very, very long period of time. Of course, the folks on this call who are a little bit older than me remember that prior to 1980, we saw those interest rates rise over time. And we're beginning to enter another one of these rising periods. Why? Again, inflation. We have a tight-ish labor market. We have a limited supply of housing. Electricity costs are an issue with AI usage and just general lack of investment into the grid. We have all these different factors that are kind of pushing us toward this more inflationary future. And how do we contend with that inflationary future? We have to have higher interest rates. So one thing that's always peculiar, though, I find, and this is over a 40-year trend, is that these interest rates just happen to line up really, really closely with the heights of the Fed chairman at the time. So very, very bizarre factoid, but you're here for some laughs here today too. So when we zoom out and think about inflation, again, when we're really thinking about wage pressures from that generally tight labor market, we're thinking about shelter costs, given the lack of housing inventory that's out there, generally speaking, energy costs, all these things are leading toward a more elevated pricing future. So right now, when you're maybe not quite as busy, MTI sales up 1.7% year over year, we want you to be taking some of that time that you may have to think about how can you plan for those price levels going up? How can you plan for interest rate pressures? How can you basically get ahead of that curve late 2024 into 2025 or first half of 2025 is a really great time to think about those things. I'd also really urge you to check out this YouTube link. I'll be sending the slides to Tom after this, and I'm sure he'd be happy to share the link as well. But you can follow free. We have a weekly update on what we are seeing in the Fed, what they are doing with short-term rates, and related to that, a bunch of economic data points as well. So it's kind of your free weekly economic checkup, if you will. It's usually 5 to 7 minutes. Quick, easy listen done by Brian, our former CEO. And so really top quality information and an easy listen as well. So let's talk about that labor market, because that is one of the fundamental factors I was talking about earlier, as far as why do we expect this overall inflationary period over the next few years. So the first thing to note when it comes to labor is a local phenomenon as well as a national phenomenon. And when we're talking about localities, we see really big differences in the labor market, depending, of course, on what industry you're in, many different factors. But one I think that's sort of underreported a little bit is the different geographies. And when you think about the labor market in a place like a Florida or a place like a Texas or a place like Utah or Idaho, where you're having a ton of people moving into those states over the last few years, it's a really different sort of labor market than if you operate, say, in Mississippi or California, which has actually been losing folks over the last few years. So just take that into mind when you're doing your planning. All this data, of course, is going to be national data. But when we think about what areas have more folks in them are driving economic growth, have more labor to begin with, it tends to be those darker green states, and those red states or light green states aren't quite as dynamic economically. So it's just interesting, bouncing around. We travel a fair amount here at ITR, giving different presentations, and it's just interesting bouncing around to different states, hearing from different folks and how they're doing. I just got back from North Carolina, very vibrant area of the country economically. You can see that 3.2% growth rate for population growth. Lots of folks who are down in that area seeing a lot more economic activity than just a couple states over, for example, in West Virginia. So in terms of that tight labor market, though, here is the chart that we like to look at. And this is looking at the number of unemployed people per job openings. So this is saying that for every one job opening, there's only 0.9 unemployed people. So another way to think about this is that even if every single unemployed person magically filled a job opening, we'd still have job openings left over. Of course, that won't happen because of the skills mismatch. You can't just take an unemployed person and plug them into a job opening. But I think it just illustrates the point that there's really, really not enough labor here in the United States for the number of jobs that we have to do. And so what does this mean? It means even though the labor market has cooled some, certainly from where it was just absolutely white hot in 2021, 2022, it's cooled some to be sure, but it is still a fundamentally tight labor market. And what does that mean? Well, it means some good things. It means that workers are seeing wage gains. They're going out and they're spending more on services. They're spending more on retail goods. They're propelling the economy forward. That's the good side. The potentially problematic side is with those wage increases comes inflation. And so just, again, all of what I said earlier about pricing holds true. You want to become more efficient in what you do. So looking forward, when we think about labor, we are going to see the rate of rise in labor costs decrease. We call that disinflation if we're economists, going into 2025. But we're not going to see wage costs go down, labor costs go down. They're going to continue going up just at a more modest pace. That's very, very likely to pick back up in 2026 alongside the economy. Fundamentally, though, when we're thinking about the next few years, we're thinking about a tight labor market. That's just a math problem. When you have baby boomers going out and you have Gen Z coming in, that is a smaller generation, you have more workers leaving the workforce than they're being replaced for. And so really thinking about how can you cultivate those folks who are a little bit younger in your organization, maybe they're millennials, maybe they're Gen Z. How can you hook them on your culture? How can you make sure that you are retaining them over the next chunk of time is a really, really critical part of planning for the future. Because not a lot of those folks, it's right now pretty easy for them to get jobs. And so we want to be making sure that we're hanging on to them as we move forward. Okay, so let's take a quick turn to the macroeconomic trends here, and I'll start with the big kahuna, GDP. So when you look at GDP, it has been rising very nicely compared to where it was pre-COVID. You can see we've well surpassed that COVID low. And when we look off into the future, these are the little diamonds on our forecast. We are planning for growth in 2025, and we are planning for growth in 2026. So a no recession outlook here at ITR. That being said, we are very likely to see the growth rate here in blue on this different chart come down. So already we are seeing GDP growth slow. It is likely to continue to slow for the next couple of quarters, and we're not going to see the blockbuster economic growth that we saw during the COVID period. Why is that? That's not a political statement. You can see these gray bars that represent the different presidents as they've come along to the economy. And it's really hard to tell any sort of distinct pattern, whether you're Democrat or Republican. It's really hard to say, oh boy, only when this particular political party is in office does the business cycle suddenly change. That's not the case. And so our forecast, we have not changed our GDP forecast since Trump was elected. That wouldn't have changed if Harris had been elected. It just is a function of the economic circumstances of the time. And so when we look at those leading indicators and we see GDP growth likely to decelerate here for another couple of quarters before picking up a bit in 2025. That's a function of the economic fundamentals, not of the president in office. So taking a quick look at the same chart, but instead of GDP, we're going to look now at U.S. industrial production. This is much more of a close tie to MTI. So this includes manufacturing, as most of industrial production also includes mining and utilities. But when we look at it and we compare it to the ITR leading indicator in blue, you can see right now industrial production is basically flat. It's down 0.2% year over year. And when we look off into the future, it's looking better. I mentioned at the beginning of the call, the leading indicators are rising. You can see right now the leading indicator, the ITR leading indicator is at negative 0.5. That ascent is a good sign as we head into 2025. It means that we're likely to see the growth rate for industrial production pick up a bit. The other thing, though, that you can notice about that blue line is when we see incredibly steep rises. I'm talking about coming out of the Great Recession low here. I'm talking about coming out of the COVID low here. Typically, when we see really sharp rises in the ITR leading indicator, that leads to really sharp rises in industrial activity. And when we see mild rises in the ITR leading indicator, think of 2015, 2016 in there, we tend to get more mild ascents in industrial production. And that's what we're seeing this time around. We're seeing a more mild ascent in the ITR leading indicator. And so that's why our forecast for industrial activity is for growth, but not blockbuster growth over the next couple of years. So one interesting thing just to flip back here for a second, we have 2.7% GDP growth, and we have negative 0.2% in terms of industrial production growth, or actually mild contraction, basically flat. When we think about how those two trends compare, it's really interesting to think about how is the industrial side of the economy doing relative to the service side of the economy. And what you can see here, this is a chart on log scale, is industrial production in navy and services GDP in teal. And clearly, services GDP across time has grown significantly faster than industrial production. So there's a number of reasons for that. We've seen some industrial activity leave the country in prior years. We've seen just a really strong consumer base here. Some of that's just natural consumer activity picking up as the U.S. economy matures. But basically, if we're talking to an industrial client, it's much more likely we're seeing flatness, maybe mild growth, maybe mild decline. Whereas if we're talking to a more services-oriented client, we are seeing typically growth there. In 2025, the good news for industrial clients such as yourselves is that gap isn't going to be so severe. We're going to see industrial production pick up. We're actually likely to see services growth decelerate a little bit. And so they're going to become more in sync in 2025 than they have been. What that means from a capital goods perspective is right now we're basically flat in terms of capital goods expenditures on new orders, but we're going to see that pick up some mild growth in 2025 and 2026. So that is very good news for MTI, and it's also good news for other industrial clients as well. One of the drivers of that is going to be corporate profitability. When you look at corporate profits here in teal, you can see the most recent 3 months are up basically 6% versus those same 3 months 1 year earlier. And so as we see firms more willing to go out and spend those dollars, it's going to lead to greater capital expenditures. Firms have been waiting on a couple of things that we talk to anyway to spend that CapEx. One is the results of the presidential election, done. Another is business confidence has just been a bit low. That's not going to last forever. And third is interest rates moving lower. And interest rates in terms of short-term rates are beginning to come down a little bit. Long-term rates more flattish right now really than anything if you look over the last few months. But overall, we're expecting a little bit of interest rate relief, and that's very likely coupled with good solid profits and the election behind us, more capital expenditures as we move forward. The other leading indicator we like to look at for capital expenditures is machinery manufacturing utilization, and that is still declining. It's still down from 1 year earlier. So you can see machinery utilization is down, that negative number there in teal, but you can see the rate of decline is easing. In other words, that teal line is starting to go up. And when that teal line starts to go up, you can see pretty clearly that new orders tends to head upward about 5 months later. This chart is shifted to take into account that lead lag relationship. So the teal line is actually shifted forward by 5 months. And so what you're seeing here is the possible future trajectory of new orders over the next couple of quarters. Of course, those dots there in blue represent our forecast for capital expenditures as represented by non-defense capital goods new orders. And you can see that upturn in growth over 2025, 2026. But again, those growth rates quite a bit lower than we saw during the COVID period or during the 2017, 2018 cycle, either of those cycles. Be more muted growth. When we take a look at our industrial production forecast, we're seeing a very similar effect likely. So right now, we're basically, again, flat on a year-over-year basis for industrial production. You can see on the top-hand panel of your screen, those dots begin to increase slowly over the next couple of years. And we're talking about 1.4% growth for 2025 and 1.5% growth for 2026. You can see what that looks like on a data trend basis on the lower hand panel of your screen. That 12-month moving average or 12 MMA is in green. And you can see that we're basically calling for mild rise over the next couple of years for industrial activity. So that's the outlook for industrial production. Another thing I just wanted to show you to keep in mind with those GDP figures, and I like to say this to, in particular, manufacturing-related clients in some way, is when you think about private data center construction, that's a part of GDP. And when you look at data center construction right now, you can see it is growing at a nearly 57% growth rate. That's the top-hand panel of your screen. Sectors like these get tied into GDP too. So when you have, this isn't a huge sector of the economy, but it's certainly a rapidly growing one that's going into that 2.7% GDP growth, just as the flat industrial activity is too. When you think about manufacturing activity, going to see a very similar shape there to industrial production. Again, growth picking up in 2025 and into 2026. Mild rise more than really robust rise. So wanted to take a pivot here for a little bit and talk about a couple of issues that people tend to be concerned about when it comes to the economy. One question I get quite a bit is, shouldn't we be concerned because credit card debt is at a record high? I'll often actually get notifications on my phone, the credit card debt is at a record high. If you look at that data, and that's not what we're plotting here, you would notice that over time, credit card debt is almost always rising. It rises with inflation. Sometimes consumers may take on more debt than others, but really that's not the economically meaningful question. The economically meaningful question, and what I think people are asking when they ask that question is, should I be worried about credit card debt? And the answer to that is on this chart, and the answer is no. When you look here in that teal line, that 14.5% represents credit card debt as a percentage of earnings. And so it's really looking at how much debt are people taking on their credit cards relative to their incomes, their ability to repay that credit card debt. When we see that percentage really, really high, and I draw your eye to pre-Great Recession here, that foretells trouble, right? That is not a good thing when we get those really unsustainable debt loads, either from a credit card perspective in teal or from an overall perspective in navy. But right now, when we look at credit card debt, and when we look at household debt, they're at very reasonable levels relative to people's ability to repay those debts from an aggregate perspective. That doesn't mean that some people aren't overextended on their credit cards or bought too much house or underwater on their car loan, right? These things happen for pockets of people. And, we obviously are people in addition to economists. That can be really, really painful and really, really difficult for those households. But from a macroeconomic perspective, which is the purpose of this presentation, I just want you to know that credit card debt and household debt are not particularly onerous at this time, and they're really suggesting that we're going to be seeing growth in the economy over the next couple of years when you take it in consideration with all of the other indicator evidence as we do. So debt looks pretty good. When we look at real personal incomes, either excluding transfer payments like Social Security, for example, in Navy, or we include them like in teal, right now we're basically on the long-term trend. Over time here, you can see that real personal incomes are rising. And this chart is really simple to interpret. When we see income go up, almost always GDP is going to be going up too. You can see that in the past when we've had income either stall out or outright decline. We can see it stalled out basically in the early 2000s. We had the early 2000s recession. We saw it actively decline going into the Great Recession. That's problematic, but when that line is rising at a pretty healthy clip, generally speaking, there's some good times ahead. So what we want you to just know from all of this is that, boy, is there an awful lot of political noise pre-election. Some calmed down, some has not calmed down. But when we look at the actual numbers, as we do here at ITR, we see an economy that is in a solid, maybe not spectacular, but solid position. We have corporate profits. We have a relatively tight labor market. We have some leading indicators going up. We have incomes rising. Debts are manageable. One slide I didn't show you was savings. Savings aren't particularly copious right now. They're a little bit lean. So really, when you kind of step back away from all that political noise and assess the economy, I would say it's in okay shape. It's in okay to good shape. It's certainly positioned for some mild growth here over the next couple of years, and businesses have that cash and are able to invest. So that's going to be facilitating some growth in some of your markets, which we're going to turn to here in just a little bit. So as you think forward, just make sure that you're thinking about how are you going to deploy that cash? How are you going to become more efficient? There is going to be some organic growth here in 2025, 2026. Per the question earlier, we're not going to see a ton of volume increase. It's going to be a good chunk of it pricing increase. So really one of the main ways you can grow your business in terms of your bottom line is by becoming more efficient at what you do. So let's take a look at some of those markets. And when we look here at fabricated metal products production in Navy, you can see that this would be a volume-based measure, by the way. You can see that volumes are declining, and they're going to continue to decline for another couple of quarters before they pick back up. So we're going to see a little bit of volume growth, certainly in the fabricated metal products industry. From a pricing perspective, though, that's looking at the teal line, you can see that fabricated metal products new orders are rising. That's dollar denominated. So denominated billions of dollars is that trend, 437 billion, and that'll be rising mildly over the next couple of years. So certainly one thing that we want you doing with your data here is calculating those rates of change and those data trends. So looking at what are your, what we call our 312 and 1212 rates of change. So how are your most recent 3 months doing with those same 3 months a year ago? How are your most recent 12 months doing with those same 12 months 1 year earlier? If you need help with that, feel free to reach out to us. We are happy to help you set that calculation up for free. We do that all the time. But you want to be tracking how your volumes are doing, tracking how your dollar spend is doing, and making sure that you're seeing any differences that are going on. Because right now, clearly, we've seen a big difference in this trend post-COVID. You can kind of see pre-COVID, since the Great Recession, that this period in here, you didn't have to worry about that so much. Much more stable pricing environment. Our pricing moved relatively similarly to how volume moved. We're not seeing that going forward. And so that's one thing to note. When you take a look at MTI specifically, as I mentioned earlier, you're up 1.7% year over year, a very similar growth rate to how fabricated metals new orders is doing as a whole, up 2.9% year over year. So very similar growth rates there. And in terms of how that looks going forward, again, we'd expect mild growth in 2025 and 2026 for both of these series. Okay, so let's turn into your actual markets. And let's start here first with a forecast that changed a little bit, which is construction machinery new orders. Construction machinery new orders are actually declining on an annual basis. We're expecting them to move flat to slightly downward over the next few quarters before they pick up in late 2025 into 2026. So 2025 might be a little bit weaker actually than 2024 for this industry. Now, why is that? Well, first of all, when you look at residential construction, that market is beginning to soften up a little bit from a starts perspective. And so we're not quite seeing the bounce there that we might want to see from the residential side. And then from the non-residential side, that's beginning to slow as well. And so 2025, most of the markets that you're going to see in this presentation, you'll notice we have a stronger 2025 than 2024. This is one of the few where that is actually not the case. So certainly in terms of some of the factors going on behind this, interest rates, you might think, oh, actually, that is going to bode well for the future. Keep in mind, interest rates are lagged significantly in terms of their impacts on some of these sectors. Construction machinery is one of those. And high interest rates in the past are going to be a drag on construction machinery projects. Construction projects that use that machinery for the next little bit. In terms of what some of the opportunities, though, are in this space, probably this public sector would be the number one area I would highlight. We already have seen earlier in this presentation, I showed you that data center trend. Well, that's not specifically public, that's private construction. That's certainly benefiting from some of the dollars going into the CHIPS Act, for example. We're starting to see in manufacturing construction, CHIPS Act related construction, that sort of techie side of the market, construction market is doing pretty well. And then we still have some infrastructure dollars to spend. So as those continue to trickle through over the next few years, that'll be bleeding into construction machinery as well. Switching over here to North America light vehicle production, we're calling for a really, really similar 2025 to 2024, quite flat. Not really much upward momentum here. We still have pretty weak sales going on. When you look at overall auto retail sales, they're well down from where they were in, say, 2016, for example, when we had all low interest rates, a lot of the promotional financing going on. We're not seeing that right now. The car companies are being a little bit more disciplined with how they're incentivizing or not incentivizing moving through those new models. But we are seeing some really different trends when we actually dive deep within the data. So one thing that's going on is when you look at RVs and hybrids, those are growing very healthily. In comparison, combustion engines not doing so well. Another trend that I wanted to make sure that you knew about was when you isolate just the luxury car brands from automotive, that data trend is actually generally rising over time, would be at more of a record, just off of a record high. Whereas when you look at all of the makes together, it's not nearly as strong. So why is that? A lot of the consumers that have done really well in this cycle are folks who are on the upper end of the income spectrum. They may have a hefty stock portfolio. They may have benefited in some way from high corporate profits. They probably own their own home. They've seen their home value go up a lot with a low fixed interest rate, high home price. So they're in a pretty good spot. So if you're talking about the luxury side of the market, you're talking about the hybrid side of the market, that's the bright spot within automotive, and sort of your lower end non-luxury make, that is the weaker end of the market. Eventually by 2026, we are expecting that some rate cut effect is going to bleed through into light vehicle production, and we will start to see a little bit of growth in vehicles, but it's not going to be very marked. It'll be a pretty mild growth scenario here for automotive. Flipping along over to heavy-duty truck production, Right now, we've seen truck tonnage basically flat. It's beginning to recover, and it'll be moving upward as we head into 2025, 2026. But until that starts to occur, we'll see a little bit more decline here for heavy-duty trucks over the next few quarters. So when we're talking about 2025, we're talking about 2.4% growth relative to 2024. But the bulk of that growth is going to be occurring in the back half of the year. So if you're related to this market, think later in the year and into 2026, those are going to be your better years for heavy duty truck production. Wholesale trade is doing decently. We're not expecting a precipitous downturn. You can see, this is a highly, highly cyclical industry. Certainly got crushed during COVID, got crushed during 2015, 16, got crushed during the Great Recession. We're not talking about any sort of downturn related to that. This is more kind of a speed bump rather than a giant, huge pothole kind of situation for this market. Moving along to oil and gas, we're seeing oil and gas continue to rise. The rate of growth is beginning to diminish, but overall growth just at a slower pace. In terms of 2024 and 2025, we're looking at relatively similar growth rates for those 2 years. Sub 3% growth, which is quite a bit slower than what we've seen in, say, 2022, for example, certainly during some of the earlier periods. One thing that is really encouraging, though, about this industry is we're starting to see a more sustainable, really approach to the way that they're managing their growth. And I mean that in the sense of when oil prices went up earlier, we didn't see them really ramp up production. Oil prices have come down a bit. We're not seeing them slam on the brakes. We're seeing less cyclicality in this industry, and the businesses are managing their drilling and managing their extraction at a more I guess you could call conservative approach, and that's sort of putting this industry on a more steady growth path as opposed to certainly we can probably all remember the boom and then bust in 2013, 14 boom, 15, 16 bust, big upturn, and then COVID crash, right? We're sort of getting away from that. And that's really nice to see. So in terms of a longer term perspective, as you're looking out, if you're heavily involved in this market, we're seeing more steady growth over the next few years, as opposed to a real cyclical trend within that industry, which is good to see. In terms of medical right now is in phase D recession. So we are seeing it contract and we are seeing that rate of contraction intensify. This market really jumped during COVID. And now we're really beginning to normalize back to more closer to what we were. But fundamentally, we think there's too many tailwinds for this to go down that much further. And those tailwinds are going to be, we have a number of baby boomers who are needing those medical devices. And also we are seeing as nearshoring and reshoring occurs, and that's increasingly likely as we go forward into the rest of this decade, much more likely that that equipment gets built here in the US as opposed to overseas. So this is an industry that we'll be seeing a bit of a bounce in 2025, 2026, pretty weak growth rates, but from a data trend perspective, relatively elevated activity compared to prior years. One of the bright signs that we're seeing within the healthcare industry, more generally speaking, is medical lab service revenues are beginning to pick up. They're beginning to accelerate. And usually when medical lab service revenues begin to pick up, we'll eventually see the effect later in other segments of healthcare, one of which is medical equipment and supplies production here. So some brighter days ahead for that as well. Taking a look at civilian aircraft production, you can see this is beginning to recover way down, certainly from where we were pre-COVID. And the issue here with domestic aircraft production is not demand, it's supply. So when you look, for example, at Boeing's backlog, they have over 6,000 planes on order. Backlog is near a record high. It's purely a function of getting those planes built in this industry. So the strike is over. We are waiting to see how that data looks for the next couple of months. Now, there's really two possibilities there, and we're just want a little bit more data before we consider whether or not we need to change this forecast. Um, One possibility being that startup from the strike is particularly sluggish, in which case probably we're going to be lowering this forecast if that ends up happening. Probably a relatively similar shape to it because again, those orders are there. It's just a function of how quickly can we get those out the door. But we may end up having to take this forecast down. If we see a real sharp bounce back, though, this could track more closer just to the lower end of the forecast range. So stay tuned. We'll certainly be updating you. If you're a Trends Report subscriber, we report out on this particular series every single month. And if not, we'll certainly be talking about it at the next report review and in the next report. Another market that is been growing really nicely has been computers and electronics. Right now, we're seeing pretty steady growth there, just around 3% or so on a year-over-year basis. We are forecasting that growth rate will be coming down in 2025 and 2026. We've really already seen the bulk of the investment happen already in terms of that surge we saw sort of coming out over the last couple of years, coming out of COVID, as the service sector did really well. Now, a lot of the more professional services industry, particular, are not doing quite as hot, and they're going to be pulling back some of their IT budgets. So this is still a growth market. It's still a market of opportunity, certainly for the next few years. But I wouldn't expect the same pace of growth in 2025 and 2026 as we've necessarily seen or earlier on in the prior couple of years. And then last but not least, we have our farm machinery shipments forecast. And this is looking like a growth market as well. We are just entered into phase B accelerating growth here. We're up 0.9% year over year for this market. We did change the forecast a little bit more muted of a rise. Just some of the commodity prices haven't held up quite as well as they might have otherwise. So a little more muted growth for 2025 than what we had, but still some nice growth here as that food industry bounces back from the last tough couple of last years. So just to wrap it all up, and then I'd be happy to take any questions. Interest rates are going to be moving a little bit lower in terms of short-term rates into early 2025. Don't expect that much interest rate relief, though, on a short-term basis. Why? The Fed really has its hands or work cut out for it, hands tied a little bit, because you have that tight labor market that's going to limit the amount that they're going to be able to cut in this cycle before we see inflation pick back up. So when you think about that, if you see lower rates from a short-term perspective or a long-term perspective, think about that inflationary future that's coming and think about what could you do now to prepare for that over the next couple of years. I was on the phone earlier with the ITR Economics partner, and she was advising one client who is in the metals space, and they really stocked up early on in COVID with a bunch of raw material, and they were able to just really make a killing on that as the stimulus rolled through in 2021, 2022, and saw some really high growth rates. Of course, prices went up, but they already had the material. That's not going to be the exact same playbook this time around. As I was mentioning earlier, we're talking more mild rise. But that thought of, this business thinking during 2020, how can I prepare for economic growth that's coming even though it's COVID? Think about, now we're in a little bit softer spot for industrial production. MTI growth rate is, 1.7%, not that strong, but we're going to be seeing a little bit stronger future. How can you get ahead of that now and use some of those low interest rates to your advantage? So along with that inflationary pressure, it's going to mean margin squeeze. So thinking about how to communicate your competitive advantages, how to communicate the how you can be a really valued partner to your clients is going to be really key to being able to make sure that you're profitable through this period. And then the last point is just thinking about some things more personally in terms of digitizing and using AI. That may or may not make sense for your business, but thinking about how to be more efficient, thinking about how to have better competitive advantages, that's going to be really key when we're talking about a mild growth environment. You can't just rely on sort of that organic opportunity that comes with really, really robust growth rates, like we saw in COVID, for example, or we saw in 2017, 2018. It's going to be a little bit more about managing your business carefully. And then the last point, we're making it here about stock asset classes, particularly for individuals, but it applies to businesses as well. We're talking about that inflationary period for the next 5 or so years, but after that, the first 6 or so years of the 2030s, we think is going to be really economically painful. That's when we have to take care of our elderly population. The fiscal budgets are going to be most under their strain, healthcare resources most under strain. We already have really significant debt to GDP ratio here in the US, and that's going to be getting worse. At some point, that's going to be a real pain point. So thinking about how you can make your money now over the next 3 to 5 years or so and be prepared for that more difficult period as we enter into the 2030s is going to be really important. Okay, so that's what I have for you here today. If there's any questions, I would certainly love to take them. So feel free to either unmute or you can drop a chat in the chat box to me privately, and I would be happy to answer any questions that you have. While folks are still thinking of some questions, I will say one question we've got a lot is what kind of investment do you want to make here? ITR, you're telling us to be more efficient at what you do. What kind of investment should we be making? The way I've been thinking of answering that question, obviously it'll be different for every business, is keep in mind that forecast for that really difficult period of the first 6 years or so of the 2030s. I want an investment if I'm a business owner that's going to have a, say, 3, 4, 5 year payback, short-term ROI. And I want to get that in place relatively quickly at the interest rate low in this cycle. And that's going to mean sometime in 2025, first few quarters of 2025 is likely when we'll see the low in interest rates and long-term rates that actually may even be behind us slightly. So thinking about kind of what are some of those quicker, more quick payback kinds of things so that as you enter the 2030s, you have a really rock solid company, really rock solid balance sheet. That's the mindset that we want our clients to be in. Okay, one question. This is a good question. I like this interesting question. Okay, so why 6 years into the 2030s? In other words, what happens after 6 years that will bring relief? Really important question. So let's think back first on what are those drivers of that depression period that we're calling for in the 2030s. We're talking about baby boomers aging. They're not in the workforce. They are drawing on Social Security. They're drawing on healthcare services. Eventually, right, that elderly population sadly won't be at its peak. Those 6 years are going to be when the fiscal and healthcare crunch is at its greatest. And so we're really talking about that from a demographic perspective and from a fiscal perspective. We think it'll take about 6 years for us to get through that period. Other thing I'll note, obviously that's a forecast, and we're talking, 2036 would be, what is that, 12 years from now, roughly speaking. If it's 5 years or 7 years, right, we don't know that for absolute certainty by any stretch of the imagination. I don't want to give that away. But what we do know about that period is it's very likely to be a longer term recession as opposed to some of the shorter recessions. And I would even include the Great Recession as an example of a shorter event, which I know is really hard to believe because that was painful. But Great Recession was incredibly sharp down for a relatively short period of time and then incredibly sharp up. We're talking about a much more longer term period of decline. Not necessarily as sharp for any one particular year as the Great Recession, but a longer term decline. So, what does that mean from a business planning perspective? It's going to mean that those people who have those really solid balance sheets are going to be able to survive that event in a way that people are, have a 1 year cash reserve, are not going to be able to manage that nearly as well. So, really, it's a demographics, healthcare, government spending related forecast in that regard. Any other questions I can answer? Okay. Well, as usual, I will get the recording over to Tom and out to you all. If there's anything you need, feel free to reach out. Um, and hope that planning for next year goes really well. Again, keep in mind that sort of mild growth mindset and how can you be prepared for that now? And what are you going to look back on in 2026 and think, oh man, if I'd only done that in late 2024, would have been in better shape. That's the kind of mindset that I'd urge you all to have. Anyway, hope you all have a great holiday season, and I will catch you all next quarter. Take care, everybody.